what it is.
Yeah, and I think,
I just don't want people to lose money. That's that's why I'm so, I've been through this and I'm looking at what's about to happen. I believe. I mean, I'm looking at all kinds of stuff right now, and this manufacturing is not good. Okay,
yeah,
it's not good. And we can talk about that today because I got some charts that are pretty interesting. And
okay.
yield curves have reinverted. That's another bad thing. Bankruptcies are up. Household debt, layoffs. I mean,
Welcome to the Best of US Investors, two regular guys show. I'm Trent, this is Mark, and today we're going to get into government reports. Yay, government reports! And we're going to break down how those reports are affecting the stock market today, along with we're going to look at some charts of stocks and indexes, and we're just going to have a random walk talk down the road at the very end about. So let's get going.
okay.
Hey, Mark.
Hey, well, it's Tuesday, September 3rd. It's a little before noon. So if we do charts, that's what time we're showing these charts. And it was had a nice 3-day weekend. How was your weekend? Good.
It was good. It was
Yeah.
good.
Good.
Geeked out a little bit on coding,
Oh, not
computer
me.
coding. But
Not me.
anyhow,
I went to football games and enjoyed the weather. And September's really nice around here, so that's why
there
I'm
you
going to
go.
do it. So, anyway, today we have the markets. It's a short week. If I can get into my charts here, I'll
Yeah.
short week, and we have some reports coming up,
Okay.
and mostly it's the labor reports coming up on Friday. So we're looking at the S&P 500, and today, the S&P is down almost 500 points right now. The Nasdaq 450 and the S&P or the Dow Jones is down 500. The S&P down 450, and the S&P is down 90. Here's the SPY. Okay, the weighted S&P 500. You can see we have come up here ever since the 19th of August and hit the green line of death, which is the upper resistance level. Okay, the intermediate resistance level, and we've come straight across. And today, again, we're under the 9. We're falling in this channel, and we're finding a little support just above the 20. We're above the 50. Again, sideways movement. This is even after we saw, Nvidia's earnings and everything. The
Yeah.
MACD's coming down, the stochastic's coming down, the RSI is coming down. Okay, so this is what we're seeing today. Let's go over to the Qs and see what that looks like. Okay, it's come out of its channel, down below the 9, down below the 50, even down way below the 20. Got converging Bollingers, uh, the oscillators aren't looking good. We don't have a MACD crossover yet, but it's very close. I'm anticipating it will based on what I'm seeing in the stochastic. And then the Dow Jones has been doing well lately, kind of the opposite. But you see, it's come up and it's hit not only the green line of resistance or the green line of death, but it's also hit where we have sell orders. You can see now we're finding some support right on the 9, but we're seeing a little bit of a bend here on the
Mm-hmm.
MACD and a little bit of the momentum coming down the RSI. So sideways movement now on the Dow. So why is this happening? Okay, let me get out of that. Okay, so the ISM manufacturing PMI came in today and it edged up 47.2, but it's still in contraction mode because 50, anything over 50 would be growing or expanding. We're still at 47.2. Okay, so that was missing expectations of 47.5 and reflecting the 21st monthly contraction in US factory activity in the last 22 periods. So 21 out of 22 months we've been contracting basically. So the result extended the weak momentum for manufacturing in the U.S. economy, underscoring the impact of elevated interest rates by Federal Reserve in the sector. So these interest rates, remember, when they first started coming out, you and I were talking about it's going to take 12 to 18 months for these things to hit the economy.
Right.
Well, the Shinola is starting to hit the fan now. Okay,
Yeah.
and we're seeing the effects of that. So, what are other things does the manufacturing PMI tell us? Employment levels fell for the third straight month. Okay, 46 versus 43.4 at a slower pace, but it still fell. On the price front, costs rose faster pace, okay, 54 versus 52.9, firmly above the market expectation that there would be an expected slowdown in costs, challenging the Fed's hope of disinflation in the economy. So we're seeing the costs go up, employment come down, and we're seeing manufacturing still in, decline. So when you think about that, next time we have a PMI that comes out, purchasing, talking about PPI, when the PPI comes out,
Yeah.
so producer price index, think about these reports right now saying, hey, the costs are going up, and that's going to reflect. So let's cut interest rates because we have inflation under control, but do we really have inflation under control? The markets can read this, okay? So then, if we couldn't have been even better, okay, the U.S. manufacturing, S&P Global U.S. manufacturing PMI came out, and it was revised slightly down to 47.9 in August from a preliminary of 48, and continued to point to the most market deterioration in the health of manufacturing sector so far this year. Production decreased for the first time in 7 months as sales continue to fall amid increasing reports of demand weakness. Why is there demand weakness? Because people aren't buying. People are worried about their jobs. People are in debt up to their necks, okay? Inflation's still out there. Look at housing. Look at insurance. We've talked about all this. Also, a renewed reduction in employment was also recorded amid spare capacity in the sector, meaning they have capacity, so people are sitting around. So when people are starting getting laid off, we've already seen people's hours have gone down. Now they're starting to get laid off. Also, demand for inputs would scale back, which means demand for me to bring in vendor supply products, okay, was scaled back in response to lower new orders. They're not getting the orders, leading to a first shortening of supplier lead times for 3 months. The pace of input cost inflation quickened to a 16-month high, with output prices also rising at a faster pace. So input prices are rising, output prices are rising. So, I mean, I'm not trying to be a doomsdayer here, but I'm just reading what the report says, okay? So that's what it's telling me. So I'm not Steve Leisman. I'm not going to look at page 897 and see, right. Oh, on the bright side, the sale of Dove soap went up or whatever. I'm just not going to do that. I'm just going to read it.
Yeah, I think
I'm going to go ahead.
No, it's interesting you bring this up because two things that happened this weekend was one, I saw this locally. Our Toyota dealer is offering 1.9% interest rate financing on Toyota Tundras and Tacomas, and saw a video just where a guy explained that Toyota can't sell trucks right now. They can sell Corollas and RAV4s, but trucks they cannot sell. They're trying to get rid of them. And second thing I heard this morning was on a research call that I jump on, that commercial lending, residential lending, credit card lending, car lending, all basically went flat the month of August, which tells me people are maxed out. Credit cards are maxed out already. My credit's crap. I can't borrow anyways. So what's the point of even filling out an application?
Absolutely.
Yeah.
Yep.
Yeah.
Let me look at, show you a chart here.
Okay.
And this is just ISM manufacturing versus PMI manufacturing. You can see we go back to September of 2021, so 3 years ago. And again, here we are. This is S&P Global coming down. This is June, July, August. And here we are, which is the ISM manufacturing. So we are still under the 50 level, okay, and have been, and we're heading down. So let's look at one more.
50 is that threshold, right?
50 is the line between contraction and advancing. So let's look at,
as long as we continue to stay below 50 and head south of 50, no bueno.
We're in contraction. Good. Yep, we're in contraction.
Right.
So let's look at just this is the ISM Manufacturing Index, and this shows basically we're underneath the zero level right here. And you look back, when was the last time we were basically under the zero? Or, well, 2000. Okay.
Yeah.
Here's 08. What happened in 08? Okay.
Right.
Here's around 12, 14, 15. We had a blip. This was the pandemic, and here's where we are now. And I don't see a spot other than back here in '08 where we've been down that far. Okay.
Yeah.
So definitely, you know, it's not a good sign from
No,
my point of view.
no. I think, and the thing is, it just seems like it's going to accelerate. We're we hit that curve where everything is starting, like, people aren't borrowing money, people aren't purchasing, it's too expensive. Now we start heading down the other side of the bell curve.
Yep. What else went down today? U.S. construction spending in the United States fell by 0.3% month over month to a seasonally adjusted annual rate of 2.162 billion in July 2024, following an upward revised flat rating and below market expectations. So we're seeing construction spending also go down, both residential and commercial. Okay, so the bottom line, our core outputs are shrinking, which means we're not making as much as input costs and inflation expectations are rising, okay, in our manufacturing and construction world. So that, to me, dusting off my economics degree from the fine land grant college here in the Midwest, university here in the Midwest, that's not a good thing.
Right.
One more thing, we talked about when the Fed starts lowering rates, the actual what happens is we go into recession, and we showed the Fed chart. I can show it again, but I don't want to keep showing the same chart. So what's happening on the yield curve? Well, last week it uninverted, okay? And we talked about uninverted. An inverted yield curve is when the short-term yield is higher than the long-term yield. So this hurts banks because banks borrow on the short term and they lend on the long term. So if the 30-year is at 4.1%, and you're getting the short term at 5.5%, that's inverted.
Right.
You want it the other way around. So what happened last week is it did switch between the 10 and the 2s. So under normal circumstances, long-term interest rates are higher than short-term interest rates when annualized, principally because the long-term is usually perceived as riskier, and so long-term debt demands a higher return. Well, that's not what's happening. Now it's starting to happen. Again, normally if you plot the interest rates at different maturities, you get an upward sloping yield curve. But if for some reason the short term becomes unusually risky, the curve, or portions of it, become downsloping, and that's why. And why is that important? Well, the graph makes it clear that this kind of yield curve inversion has been associated with impending recessions. Okay, so as the yield curve gets closer to such a situation, there's going to be a lot of interest in it. But let me show you this chart.
All right.
This is so this is from Fred against the Federal Reserve, 10-year versus the 2-year. This is when a yield curve inverts, meaning that short-term rates and yields are higher than long-term rates. Here's 1980. You can see it inverted, and when it came back up and reinverted, recession. Here we came to 1990. This is before the 1990 recession, reinvert, recession. Here we go in the 2000s, okay? Reinvert, recession. Gray line equals recession. Here's 2008. Well, I kind of got it covered, but reinverted, recession. Then we had the yield curve come down, and here's where we are today. We're on in the end of August, we're right at zero.
Yeah.
Okay. So this, along with the Fed is looking at the same thing we're looking at here. And so what do you think is going to happen? I mean, we see signs and signs and signs over and over again that when this happens, recession, when this happens, recession. So I think that parts of the economy are already in a recession, but I think that we're going to figure it out really soon here that we are in recession, or we're going to go into recession. Just showing what the charts tell me, and just showing what the government reports. Okay.
But it's like what history tells you. You look at the yield curve.
It is history. Yeah.
And every time it's correct. I'm sitting here looking at the yield curve chart, and I'm like, it's inevitable. It's going to happen. You're seeing money float into the longer term bond market out of the short term bond market. It's going to be good for a fall in 10-year yields is good for if you could get a mortgage, but the problem is the cost on that mortgage is still so high. It prices most people out. But also the whole moving of interest rates lower is not going to benefit you and I, two regular guys. It's going to benefit those who can borrow at the Fed window. So I
Yep.
think I was thinking about it this weekend because I'm trying to be more knowledgeable of the two candidates who are running for president. And I'm just looking at it going, you know, you just leave Fed funds rates alone. Just let them be there, stay there. It's going to hurt. But at some point, we have to reset economically. And I'd rather sort of have it be a grind instead of a drastic collapse. And we've seen those in history. So I don't,
So when you say reset, what you're talking about is asset prices coming back down to where they actually belong, whether they're equities, land, homes, cars, whatever, gold,
absolutely
whatever.
everything. Get
Yeah.
it because we've been so out of whack for so long now. Even going back to the extremeness of Clinton's administration and loosening the guidelines on lending, mortgage lending, and the build up into the build up dot-com crash, and then the housing boom and bust. And we're just in this cycle, and they're getting bigger and bigger and bigger. And to me, it's like, okay, it's so big now. There's so much borrowed money, so much leverage, so much debt. Let's just start tapering off. Let's start. It's going to take a while, but it'll be easier to digest instead of just clunk, you know. And I think that's what I see. I look at this yield curve chart, and I'm like, we're going to do it again.
Yeah.
Just we're going to do it again.
And we keep shooting ourselves in the foot. So I know that one side of the political spectrum, their their take on what's going on in the economy is that companies are price gouging, especially in the food area.
Yeah.
And we know that the margins are less than 2% in food. Okay, that if you have a grocery store and you have fresh produce, you only have fresh produce for a certain amount of time before you have to throw it away. Or you lower the price to get rid of it.
Right.
There's all kinds of things, milk, orange juice, all that stuff's on a timeline. Okay. If I'm on a hardware store, I can have my can of oil sit there for 2 years, or
right.
Nuts and bolts. They're not going to degrade. Okay. So that's not going to help. And that's going to cause all kinds of issues with black market and and people are going to go out of business, and there's going to be not enough product for people. And that is just ridiculous. Then they want to upgrade, they want to update the corporate tax to 28%. Well, that's a direct tax on us because corporation is going to pass that on to you. And people say, because they say corporations don't pay taxes. Well, they don't. We pay the tax. Okay. It's like an increased cost of energy for a company. They're just going to pass it on to us. Yeah. Okay. The third thing is they want to raise the capital gains tax to 44.6%. So when you buy and sell stocks, you're going to pay that much tax. So why would I even want to do that?
Okay, so this is something I'm not totally clear on. I'm trying to get clarification. The proposal is to raise capital gains tax rates to 44 and some change, right?
Yep.
Okay.
Yep.
Is that for a certain category of a certain economic demographic of group of people, or is it everybody?
It's going to hit everybody no matter what it is. Okay.
Okay. I don't know. Go ahead.
Well, it's a tax increase is a tax increase. If I'm a rich person and you take away that much, that's less money I have to put back into the markets or put back into a company. How's that going to help the economy at all?
And honestly,
they always said, what's the old saying? I've never worked for a poor man.
Right.
I never have a job from a poor man.
Exactly. And the other side is very wealthy people have a number of tax accountants who are going to find a way to work around it.
Absolutely.
So at the end of the day, it's the middle class and lower class that pay for it all. So I think that's some misguidance that we're seeing for probably a number of years now, a number of presidential cycles. And that is we're seeing manipulated numbers that are more favorable to the the sitting administration. And more, and I think I've become more and more aware of it the last 2 years than I have ever been. because when I see the these numbers, the ISM numbers, I see the CPI numbers, I see this, and I go, how can I believe any of this stuff?
Yeah.
Because what I'm seeing is that it's getting more and more expensive for me and my family to live. It's getting
Yep.
more and more expensive for the average, the regular person, the regular family to live. And yet there's such a disconnect between Washington and us. And we
Yep.
have to become more aware of it. And responsibility needs to be taken for
Yep.
sure.
I mean, we
So
looked at the GPA, the last week we looked at the oh God, GDP,
yeah,
and everyone's, oh, it went up, whatever. And I'm like, when you look into it, you know, what we're spending is 0.5% more, and what we're making is only 0.3% more. So
right.
we're still not even yet. We're still going in the hole. Okay, that's what's happening. And then on top of that, the last thing that they want to do is put a 25% tax on unrealized capital gains. Okay, so that's, you haven't even sold your stock yet. You haven't sold your house yet, but they want the money,
Right.
up front. And who's going to spend the money better than you? The government? Have they been spending your money pretty well? I don't know. That's up to you to decide. I'm not here to be political. I'm here for economics, but economics is part of what they're trying to interfere with here. Free
Yeah.
market system.
Well, and that's the thing is they start taking that away from you. Um, they take away your ability to make a decision that's best for you and your family. I think they call that socialism
Yeah.
or something like that. And I think we have to be aware of, you know, these things that could be trickling into our personal economies. Um, so yeah, I mean, not to get too political, but recently it's just coming up so much. It's
Yeah,
like,
no, it isn't, but it affects economics and it affects us in the markets and it affects us personally. So, we're a financial channel, we're a stock channel, we're just, you know, two regular guys talking, and that's what we see as two regular guys in two different parts of the country.
yeah,
Let's talk about other things we see. Let's say bankruptcies. So,
okay,
according to the statistics released by the Administrative Office of the U.S. Courts, annual bankruptcy filings totaled 486,613 in the year ending June 2024, compared with only 418,724 in the previous year. So, bankruptcies are going up. Business filings rose 40.3% from 15,724 to 22,060 in the year ending June 30th, 2024. Non-business bankruptcies rose 15.3% to 464,500 from compared with 403,000. So bankruptcies over the last year have gone up. Not a good sign either
yeah,
that we're doing very well. And then I just want to kind of finish on uh, a few things. Why are bankruptcies up? Well, it's probably because household debt is up. So again, a quarterly report published by the Federal Reserve Bank of New York on household credit and debt found that between the first quarter of 2021, second quarter of 2024, credit card debt is up 48.1%, while household debt, which includes mortgages and auto loans, is up by 21.6%. In dollar terms, credit card debt rose from 770 billion in early 2021 to 1.14 trillion in the most recent quarter, and household debt increased from 14.6 trillion to 17.8 trillion. So again, household debt's up, income's not up fast enough to cover that based on the inflation rate that we're seeing and also the devaluing of our dollar. So no wonder that a survey conducted by the Public Religion Institute Research Institute found more than half respondents believe that the American dream still holds true. This was 12 years ago, okay? That it still holds to more than half. But now only a third feel that way, according to the recent Wall Street Journal poll. The study also found an increasingly large gap between people's economic goals and what they think is actually attainable, a trend that was consistent across gender and party lines, but was especially common amongst younger generations. So we're losing our younger generations. They can't afford to buy houses. They can't afford a lot of the stuff that we did because inflation's there and we're devaluing our dollar. Okay.
mm-hmm.
So, I mean, I could go on layoffs and job and closings of businesses, but just got to look at it. I'm not trying to be negative, but somebody has to counter all the happiness and unicorns on that you hear on the financial news networks, and you go and you watch these guys on the halftime report, and this company's doing good, and blah blah blah. I own it, so you should own it, so that I can get out. When you pump it up a little bit, and
Right.
that's just not right. And I think it comes to a bigger uh, idea of what we're talking about is you just need to be careful with your money right now. I mean, I'm looking at this. I've talked to you. You don't need to be. I mean, we do swing trading on Platinum Channel. Kerry looks more long term. He's focused on AI and what he believes the future is going to be. You don't need to be as a swing trader or an investor in the market all the time. I'm not giving financial advice. I'm just telling you, um, opportunity cost can be lost out there if you get into a bad position on investing or trading, and you can be in the hole for years. Okay.
Yeah.
And so you work really hard for your money, learn how to trade, learn how to invest, utilize both fundamentals and technical analysis. But again, we're in it for bunts, we're in it for singles, we're in it for doubles. I'm not looking for 100x because I've never been able to find 100x in my, 40 some years of investing.
Right.
So I'm not looking for that, but we do have, systems in place, have a trading plan, have an investment plan, and trade that way. And if it doesn't feel right, stay out of the market, because if you get in, the institutions are way smarter than you are. They have way more tools, and they'll find a way to take your money away from you. They just will.
Yeah, and I think it's you and I were talking off camera about just how that human emotional side comes into it, and I think it has a lot to do with how have been taught about investing. That if you're out of the market 10 days, you miss X number of days of the best returns. This, that, and the other. Um, as well as how we are as society always having to have instant gratification. Having, I see it amongst myself, amongst my family, amongst people around me, when you're driving down the road and you're making a left-hand turn on your left-hand turn signal and you're staring at your phone while you're making the turn, there's something wrong. There's something wrong going on there. You don't need to always be engaged. You don't need that stimulus. And I think that's the same with investing. And I'll look at it from a long-term perspective. If you lived 10 of the best days of the market, you also most likely will miss the worst 10 days of the market. And over time, you will make money. And you look at some of the greatest investors of all time, and they get out. They have a process and they have, a policy that they put in place. And when those certain elements execute, they get out or they get in. Prime example, he's deemed the best investor in history. Warren Buffett is selling off his Bank of America stock. Why? He's held it forever. Something happened that it no longer meets his criteria, and now
And
he's
Apple.
selling it, huh?
And
Apple.
He's selling on. He's going to cash. Okay. So
Yeah,
he has a system. And if you look at his Buffett indicator, you'll know why.
yeah,
Okay.
yeah. And the thing is people don't go and say, "Oh, Warren, you're going to miss the 10 best days of the market in the next 12 months." No, but we don't follow any. Most investors don't follow that system, and I think that's the point of this. Is it's the way it was explained to me. Music is the gap in between the notes. That's what creates music. And I think if you look at investing, it is the same way. Today is not the time to be in this market. Heck, I would argue that for many companies since March has been the time not to be
Well,
in certain
there's
types of investments.
there's select parts of the market like the Mag 7 did really well earlier,
Uh-huh.
but now we're starting to see a little bit of a turn in that. This is the Buffett indicator. This is market cap divided by US GDP, and you can see it's up in his danger zone. And
Okay.
yep, and so you can see back, this is higher than it was back in '08.
Wait, yeah.
So you can see why he's probably, since he's using this as when the market is over overdoing itself beyond its, reaching beyond its skis. This is why he's probably selling off, his own indicator. We talked a little bit before, one of the greatest traders ever around 1900s was Jesse Livermore. And I won't go into his whole history, but he started at 15 trading in Boston. Okay. And he came up with a system. He watched trends and he worked that system his entire life. Okay. He would sit and what did I do wrong? He studied what he did wrong. And he would make some adjustments, not too many, so it wasn't too much. But when he got to a point where, things just weren't working, he just stopped. He went on a vacation. He went on vacation to Paris. He went on vacation to Florida and he looked at what was going on. And he figured it out, and then he came back in. So he was gone for months to reset his head, and
Yeah.
it didn't. And he was one of the greatest investors ever. He was not in the market all the time. Okay, and a lot of investors are that way.
Yeah. I think,
And traders.
couple of guys I follow, one of them hasn't made a trade in 3 months. And the reason is because it doesn't meet his criteria. He looks for extremes in overbought and oversold environments. And 3 months of doing nothing. Can you imagine? I'm just go, I don't see it. I don't see it. And 3 months could become 6 months. It could become a year for him. But it doesn't meet his criteria. And I think that's the part of this that people have to learn is what is the criteria that
Yeah.
creates your style of investing.
Patience and the ability to sit out if you have to, like today.
Yeah.
I'm hearing people talk about, I need what's the best stock to be in? And I'm looking like, well, there are some stocks you can swing trade. There are few and far in between. And you're in a dangerous situation because I look at the markets. The trend is not your friend today. I mean, we're down 500 points in the Dow. We're down 450 points in the NASDAQ. The tide is going out. Would you sell your boat out into the ocean today with that storm out there and the tide out? Probably not. Your risk factor. What's your risk reward? What's your risk management? Why put your capital, to a test when you know that your risk is too high? Sit on the shore, wait for the sun to come back. And when the market turns around, goes the other direction, ride that trend up. Why do you want to fight the trend? I just wouldn't. The trend is your friend.
Right.
And today it's not your friend with the way the market's going.
Yeah.
Enjoy your day. Like Margaret says, I'm going to go ride my horse.
Exactly. And I think that's part of this. I think people should pay more attention from a long-term perspective of where markets are trending. If you look at the S&P 500, if you pull up a chart of that on a 12-month or 24-month basis, you can see where it's topping. It's tried and tried. It's exhausting. Buffett indicator, Buffett indicator looks like the S&P 500 to an extent. It's coming up against resistance. It's exhausted. It's had a hell of a run. Now it's pulling back. The logical thing is to say, okay, once it hits this level, I'm out. Go on vacation. Go buy treasuries. Go buy things that are going to go in the opposite direction. I mean, honestly, you could build a trading plan around the S&P 500 and 10-year, 30-year treasury bonds. You could trade those ebbs and moves over
inversely.
The long term.
Yeah.
And and that's still making money. That's still a process of making money. And at the end of the day, you work for 35 years, you get to 65 or retirement age, and if you've made money, that's all that matters. It doesn't matter what you owned. It matters that you made money.
My first rule of making money is don't lose money.
Right.
Rule number 2 is see rule number 1.
Exactly. And rule number 3 is go see rule number 1.
Yeah. And then come back, put a trading plan or investing plan together that works for you. And follow it. Okay.
Yeah.
If something doesn't work, readjust it like Jesse Livermore would do, or like Warren Buffett would do. Warren Buffett is not a diversified investor. He doesn't believe in it. Okay. He looks for good companies with cash flow. And if he doesn't like something, he gets out. Okay. He will get out. Everyone thinks that he just holds. He does not hold. Okay.
Yeah.
No one holds a bad equity in the upper echelon. They get out. Okay. They don't like losing money.
No.
And I don't either.
Mark, you want to hit on some charts or anything? Anything else you
Oh,
want to hit on?
we can look at a few. Let's just go to Nvidia and see what the heck's going on. Remember
It's puking up today.
that we kind of had a semi bet on this one.
Yeah, we did.
This
So
last
far.
Friday, we had a differing opinion on which way this might go, but that's why we do what we do.
Yeah.
Nvidia, uh, kind of, yeah, we're down on 7.5% on Nvidia today. You can see
Yeah.
we had kind of a bull flag pattern. Then earnings came down. It was working the 50 for a while. Now we've lost that. We're looking at the MACD dying. We're looking at the stochastic dying. Okay, the RSI is done. Here's your Bollinger Band, a lower Bollinger Band at 99.3. Okay, so you could come down, bounce off that. You might bounce through it a little bit like you did down over here. But you can see what happened last time. We just followed the Bollinger Band once we got down to that point. I don't know if that's going to happen, but all I know now is we're down below the 9, the 20, and the 50, which are now resistance levels. You've got the green line of death. It's not looking
What is
that good for
where's the
me
green light of death at?
right here, and it is at 123.27.
Which is basically its intermediate trend line. Is in that 120 range.
Yeah, it's right where the nine's coming down. So if the nine is dropping, the 10's drop or the 20's dropping, and even the 50's dropping. So there's I look at this and I'm like, there's just too many negatives on my trading guidelines to consider being a swing trade candidate at this point. I'll sit on
Yeah.
the side and watch Nvidia. I don't know where it's going to go. I just
Yeah.
know it's not going up right now. And none of the signs, nothing's green on my trading plan to tell me to do anything with Nvidia.
No, you'd have to see a major trend change in direction for it
And
to
here's
go.
your,
And it's
yeah,
got a lot of headwinds.
this looks a lot like the semiconductor ETF, the
Yeah.
SMH. Okay, same thing, came up, green line of death, down. Okay.
Yeah. Yeah.
Yeah.
Well, Mark, it's looking like you're going to win this debate.
It's not about winning or losing. It's
It's
about
about
making
making
money,
money.
right?
Right. Yeah.
We're not
But
in
it's
competition with each other.
yes.
Here's one that's, here's Berkshire. Okay. Berkshire's, under the trading guidelines, we'd have been in here about 431, and we'd still be in this trade at 479. It's following the Bollinger, really nice. Not going above the Bollinger. Okay, we're embedded here on the stochastic. We've got a nice trending up MACD, and we're doing well in the RSI. So, Berkshire Hathaway, when you look at what they hold $300 billion in cash in
Right.
treasuries right now. So, and it's a well-diversified company, even though it's not diversified, from holding every asset class. He holds things he thinks are going to make money. Okay.
Yeah.
So there's Berkshire. Okay. So there are stocks that go up. Okay. Even when the market goes down. Let's look at Coca-Cola. It's one of his holdings. So here's Coca-Cola, and it has been going up along the upper side of the Bollinger Band. And again, today, that's where it's at. Now we hit a little bit of some sell orders here. We'll see what happens in the sell orders if it can make it past this. I don't see a green line of death on this one yet, which also scares me because like sometimes in the morning you'll look at your chart and it'll be there all of a sudden, the
Right.
way the program works. But right now, Coca-Cola is heading up. I look at 1, 2, 3, 4, 5, or 6 times closing above the Bollinger. That's kind of a hard uh, indicator to get past. I think we're going to see it pull back in, and I think we're going to see it maybe start to flatten out and then come down. That's just what I see.
Yeah.
Not professional advice, just what I see. Let's look at Pepsi because that's a competitor. I haven't even looked at this chart today. Oh, Pepsi's the opposite. Look at that. Pepsi popped right up off of its 9 or off its green line in sand, went past its sell orders right up to the Bollinger Band. Amazing.
Wow.
Something must have happened to have a nice big candlestick like that, just like something happened over here to do
Right.
the same.
That's
So
interesting.
it is. Yep.
Huh. Can you take a look at Tesla?
Oh yeah. Tesla's right above the 9, okay, which is usually a good sign. We're a little flat on the MACD. Got a little bit of a rise on the stochastic at 50 on the RSI, but I got this green line of death sitting at about 219.80. and we're currently sitting at 215.10. So, and I got Bollinger Bands that are kind of parallel, but
Okay.
again, came down, bounced off the 200, which is a good level of support. It's also a good level of resistance. You can see it took a while to get across it, and it came down, bounced off of it, and it's up $1.09 as we speak today.
Wow.
Look at
Interesting.
Microsoft. Microsoft, look at this. Good line of support so far on the 200. It's holding.
Right.
Okay. But, look down here and I'm seeing, slowness on the MACD. And I'm also seeing a stochastic that's crossing underneath its percent D line. And I'm seeing an RSI below 50. So if Microsoft drops below the 200, we could see, something else. This support level would turn into resistance pretty quick, I think.
Take a look at XLP, which is
Excellent.
the consumer staples ETF.
Yep,
Broke
I did
through
good.
today.
It's been hitting the green line of death. Now it went above that and the sell orders. We'll see if it can contain. We can continue to do this, or is it going to just go sideways and come back down? These are really hard levels to get past, unless something amazing happens. Some unknown market condition.
Take a look at XLU utilities, if you won't mind.
Yep, XLU.
Uh-huh.
See, this is where they go to safety because when interest rates go down, people go for dividends, and utilities are safe dividend producers.
Yeah.
Yep.
Huh.
Here's one XLB, which was materials, which took a little dump today. It was showing a nice trend up, and this was Friday, and everything looked good, in your oscillators. And then
Bam.
boom, today we're right on the 9. It went down below the 9, come back up. We'll see if it holds the 9 or not today. We're seeing a little bit of a downtrend, MACD, a little bit on the stochastic, but it needs to hold that 9 to remain, in a positive trend as far as I'm concerned.
Interesting.
XLK is this is
Technology.
the technology. It looks just like Nvidia, doesn't it?
It does.
Yeah.
Yeah. Huh. Interesting.
Let's go to the RSP. That's the equal weight S&P. And you can see we're in a sideways pattern now in the equal weight. We're seeing the Bollinger is now right where the sell orders are. We're using the 9 as a support level. The 9's still upward trending a tad bit. We're seeing a little bit of a dip at the histograms of the MACD. We're seeing a little bit of a slide in the RSI, still above 50. But again, classic kind of like a bull flag pattern. We'll see which way it pops out, but we're not seeing much on the Dow right now.
I think that's one thing to also take into account as an investor is when you see indecision happening over a period of days, weeks. It's okay to not be involved. It's okay to sit on the sideline and go, okay, I'm just going to wait for it to make a directional change. Yeah, you may miss first up, 2 days up days, but it's better than being a part of the 2 days of downward movement.
Yeah, I always say I say it every day on the Discord. When in doubt, sit it out. If you don't feel right about it, sit it out.
Yeah.
Look at the Russell. Okay, small cap was using the 9, as its kind of support level, went sideways, and here we are today. We're almost outside of its little channel now. We'll see if it comes down, hits the 50, or if it can make it back up today, but I'm not sure. You think that with interest rates going down, the small caps would be the companies that would benefit the most for it. And right now we're just seeing, here's the 9, or not the 9. Here's the green line of death, which is the intermediate resistance level. We've seen it before have trouble. It goes up to where the sell orders are. And we're seeing the same thing again. The only difference is the Bollinger Band has come back in, and is downtrending a tad. And this one's coming up, so we're converging. So anyway, I would just be careful. You don't have to be in every day. I have an investment account and I have a trading account. My investment accounts for long term. I have a different thought process on how I invest. And the trading account is totally different than my investment account. I have Berkshire Hathaway in both. Okay.
Yeah.
One I trade, one I invest in. Okay. I
Yeah.
look at them totally different. My trading plans tell me differently. So I can take the volatility of Berkshire and get in and out. And I've been in Berkshire for a long time and it's worked out on both sides for me. But
That's good.
I do not trade my investment account like I trade my trading account. Two different game plans.
Two different philosophies, and
Yeah.
they should be.
You got to
They should
separate
be.
it in your head.
Yeah.
Okay.
Because
Otherwise, you're going to get it mixed up.
yeah, exactly. And I think that's something to distinguish and written down, as you downloaded yours the other day.
Yeah.
Can't see it, but this is your swing trading plan. This is not your long-term investment plan.
Right.
And you probably have that written down as well. And I think
I do.
that's part of, having been an ex-financial advisor, you should ask for that when you're meeting with your advisor. Can I see the written investment, plan that you have for my account? It's a fair question, because if they can't produce it,
I probably don't have it.
how are they going to make decisions, right?
Yeah.
How are they going to make decisions? So I would ask, and I think if they don't have it, then it's up to you to take responsibility to make sure they have it, and or go create your own and start managing your own money. So yeah, I think this is one of the most powerful pieces that we offer on our platform, on the Platinum platform, and that is a policy, investment policy statement. This is how we do it. This is how it's done. This is yours. You and I's are different, and you and I have talked very in depthly about building that and building a process. And unfortunately, it just takes time. It's not immediate, but it evolves over time for sure. But it's well worth doing. I would
Yes.
encourage it.
Yeah, and make it your own. You don't have to use mine because mine is for me. Okay.
Yeah.
You can use it as a model. If it works for you, it works for you. I use Bollinger Bands for moving averages and 3 oscillators. And that's all. I don't want any more. I've talked to people that say, oh, when this yellow dot turns green, then I buy. And, they have all kinds of, and then this chart over here, all that is way too much for me. I'm a simple-minded person. I don't have every single indicator up because you can get diverging thoughts based on what oscillator you're looking at, or what indicator you're looking at. So,
Yeah.
I keep it as simple as possible.
It definitely can mess with your head.
It does. And I have such little brains left anyway, so I don't
Right. You don't want to
blow it
jeopardize
on
that,
that.
right?
Yeah.
Well, all right, Mark. Anything else you want to
That's
hit on?
no, I mean I think for today we've done a yeoman's job of tearing down and building back up, tearing down the economy and building back up that there's still opportunities out there.
Absolutely. There are a
But
lot of
just be careful,
opportunities.
and again, this is not a casino. If you want a casino, take your whatever you can afford to lose. That's what all my friends say. I only take what I can afford to lose.
Yeah.
Well, I that's why I don't gamble. I can't afford to lose anything. I hate losing. And
Right.
so remember, don't play your money in your stocks like a casino. If you want to go to a casino and do that, at least you'll get free drinks and maybe a room.
Right.
You don't get that on the market. All you get is heartburn if you don't do it right. And the market is mean and it'll take your money away faster than you want to give it away.
Because Joey don't
casino.
care.
Yeah.
Joey
Yeah.
just wants to take your money so he can go
Yeah.
out tonight.
Yep.
Entertain clients. Yep.
Yep.
All right, Mark. Well, thank you again.
Yep.
It's
Thank
always
you.
enjoyable for me, and I think for the people, it's educational. It helps, and it's the viewpoint of two regular guys. So, hit
Make
the
sure you
subscribe button,
there you
hit the
go.
like button, come to bestofusinvestors.com or www.bus13.ai. That's bus13.ai, and check us out. We have a 14, and in the meantime, be safe, risk manage, and always live loud. Peace. See ya.
And cut.